Even at $220 billion, Amazon says it still will not have enough capacity. That line came straight from CEO Andy Jassy on the earnings call. $220 billion is what Amazon now plans to spend on capital expenditure this year, about $20 billion more than it guided at the start of the year. When a company talks like that, the story of the quarter is not really how much it earned. It is what it is racing to grab. And what it is racing to grab is compute. Let me start with the headline numbers. Revenue was $200.6 billion, up 20% year over year. That is the first time Amazon has crossed $200 billion in a single quarter. Operating income was $27.5 billion, up 43%. That all looks great. But one number needs a cold shower first. Net income was $62.6 billion, and earnings per share was $5.75. That looks like it tripled. Inside, that sits a $53.4 billion non-operating gain. Most of it is a paper markup on Amazon's stake in Anthropic. It is not from selling anything, it is not cash, and it does not go into operating income. So don't let 575 run away with you. The real number is that $27.5 billion of operating income, up 43%. The hardest hitting line in this report is AWS. AWS revenue was $42.2 billion, up 37%. That is its fastest growth in 18 quarters. Line up the last few quarters, 17, 20, 24, 28, and this quarter it jumps to 37. That is a clear reacceleration. For 2 years, people worried AWS was falling behind Azure and Google Cloud. This quarter answered that. And the profit is even better. AWS alone produced $16.6 billion of operating income at a 39.4% margin. A year ago, that margin was about 32%. More than 60% of the whole company's operating profit comes from AWS. It is the engine. But that margin has a little water in it too. About $600 million this quarter came from a fair value gain on energy contracts, and it mostly lands in AWS. Strip that out, and the AWS margin was up about 5.2 points year over year, not the 6.5 points on the page. So just like net income, don't treat the one-time items as the normal run rate. An analyst pushed on exactly that. Can a margin this high hold up? The CFO's answer is worth keeping. He said, it is not luck. It is efficiency, capacity optimization, and tight control of fixed costs. And yes, it will move around. So where is all this growth coming from? Part of it is AI demand for raw compute. But here is the interesting part. AI is also pulling the traditional cloud along with it. A lot of post-training reinforcement learning and agent tool calls run on CPUs, and that plays right into Amazon's own Graviton chip. Chips are the other big bet. Amazon's own AI chip, Trainium, now has multi-year, multi-gigawatt commitments from both Anthropic and OpenAI. Jassy said the AI business and the chips business each cross an annual run rate of more than $25 billion. That raised a strategic question. Bedrock is selling so well, does Amazon even need its own frontier model? Jassy was blunt. He said AWS can be wildly successful without its own frontier model, because there will not be one single model that rules the world. But he added, we are building our own frontier model anyway. It lets us control cost for our own apps, push inference prices down for customers, and set our own priorities and speed. His call. Within a few years, there will be at least half a dozen comparable models, all available in Bedrock, and one of them will be Amazon's. One more signal. Some customers now want to buy Amazon's training chips directly, outside of its cloud. Jassy said those talks are active, and he expects it could really happen. Back to that $220 billion. Why does Amazon think it earns that back? Jassy broke it into two pieces. A data center takes about 2 years from breaking ground to putting servers in and making money. But once it opens, revenue comes fast. The building lasts more than 30 years, and it can hold 5 or 6 generations of servers without paying to build it again. Servers and networking gear are the other piece. They are bought only a few months before they go live. So if the demand is not there, Amazon does not spend. They pay back in under 3 years and last 5 to 6, and most AI capacity is now sold on contracts of at least 5 years. His point is simple. Right now, so many data centers are going up at once before they can be monetized, so free cash flow looks ugly. Give it a few years. Revenue grows faster than capex, and the cash flow and returns become very attractive. They did this once before, in the first wave of cloud, just on a slower clock. He was direct about the reason for the increase. Rising memory prices pushed the number from 200 billion to 220, and even at that level, capacity will not meet all the demand in 2026, probably not in 2027 either. And the demand already booked for 2028, he called striking. The cost is already showing up on the books. Operating cash flow was strong, but trailing 12-month free cash flow turned negative for the first time at minus $7.6 billion. A year ago, that number was a positive $18 billion. The cash the business earns is being swallowed by capital spending. An analyst asked where the money comes from. The CFO did not dodge. He said, "You have seen us issue debt this year, and we have plenty of options." On the books, long-term debt nearly doubled in 6 months, and total assets crossed $1 trillion for the first time. One line that is easy to miss: advertising. Ad revenue was $19.8 billion, up 26%. It had been steady around 22%, and this quarter it sped up. It is high margin, and it is becoming a third pillar of North America profit. There are soft spots too. Next quarter's revenue guide is $197 to $202 billion. The top of that range is still below the $204 billion the street expected. The midpoint of the operating income guide only just reaches consensus. The reason for the soft guide is concrete. There is only so much capacity. Memory is getting more expensive, and those two things cap how much Amazon can sell. As the CFO put it, memory, hard drives, and SSD prices are up, and that is no secret to any company right now. Put the quarter together, and what changes is how people see AWS. The deceleration story is gone. In its place is a more expensive and more aggressive one. Spend $220 billion to grab capacity, and it is still not enough. Jassy drew a picture of demand shaped like a barbell, heavy on both ends and light in the middle. On one end, the big model labs eat enormous compute, plus a few runaway apps like Claude Code and ChatGPT. On the other end, ordinary companies using AI to cut customer service and process costs. In the middle sits most of the day-to-day enterprise workload, and most of it has not really moved to AI yet. He said that middle is the biggest future growth, and it is still early. So when you look at Amazon, don't fixate on the net income that Anthropic's paper gain inflated, and don't treat that $600 million energy item as the normal AWS margin. Watch two things: AWS operating income and how much usable capacity that $220 billion actually buys. The next checkpoint is the third quarter report in 3 months. Can that 37% hold? Is the negative free cash flow a one-time dip or the start of a trend? And will Amazon really begin selling its training chips outside its own cloud? When that lands, this story gets its first real audit.